So this week's report is about a hot topic in the financial media right now, which is buybacks. Thanks in large part to the Trump tax cuts, buybacks have soared to a record level of about 190 billion last quarter. This has led many journalists to recommend that investors should buy US large caps because of this flood in buyback. This is the cover on Barron's about 2 weeks ago. And I wanted to discuss this topic because it is close to my heart. About 10 years ago, my first assignment in quantitative finance was to look at the performance of the major stock market anomalies or quantitative factors. And one thing that really surprised me was that a relatively unknown factor, which is the buyback factor, actually worked a lot better than many well-known academic anomalies, like the value effect or the momentum factor or the quality factor. Here I ran a screen on Bloomberg looking at a backtest on Bloomberg, looking at the performance of the companies with the highest buyback yield comparing to the Russell 3000. And as you can see, the outperformance of the orange line is quite massive and is quite steady. And it's really worked pretty much ever since I looked at it for the past 10 years. This is quite surprising because standard academic theory tells us that buyback shouldn't matter. According to the Modigliani-Miller theorem, corporations cannot really increase their value by changing the capital structure. So things like debt for equity swaps, buybacks, dividend do not matter. All they do is they change the way a pizza is cut, but they cannot change its entire size. It's about the slices, not the overall pie. So how to reconcile this observation, the observation that buybacks have performed very well with the academic theorem that they should not have? Well, we need to understand that buybacks are not completely neutral. And specifically, they are not neutral when it comes to durational interest rate risk, and that buybacks are inherently a bet on falling interest rates. Let me explain. Suppose for a minute that you are a shareholder in a company that has been paying a steady dividend for many, many years and everything is predictable. Now, this company has a choice. Either it keeps paying its dividend as usual, or it suspends it for the next 20 years. And instead, it spends all its money doing a buyback. Now, if you decide to stick with the stock, not sell it, in the case of the buyback, implicitly, what you are doing is you're shifting your dividend payments. So you're saying, fine, I'm not going to get any dividend for the next 20 years, but I'm okay with that because by the end of year 20, I will own a much bigger share in the company, which will make the future dividend payments even bigger. So you're essentially shifting dividends across time. Nothing for the first 20 years, for much bigger after 20 years. The result is that you increase the duration of the asset. You can think of it, if these were bonds, you could think of the dividend-paying bond as a normal semi-annual coupon bond, and you could think of the other stock, the one of the buyback, as a zero coupon bond. And what a zero coupon bond does is that it allows you to lock in an interest rate. It removes reinvestment risk. Let's look at this graphically here, which compares the value of the two options. So the red dashed line is the expected value of the stock with a buyback. The other one breaks down the return of the dividend-paying stock between capital gains, the dividends that are being paid, and then the income that you get on reinvesting these dividends. As you can see, the three lines, the lines actually are equal, meaning that the total return should be equal. Again, that's Modigliani-Miller. But the sources are different. And if you buy a stock with a dividend, you will take reinvestment risk. So if interest rates are going to fall, you won't get that expected reinvested dividend, which is about a third of the stock value. So when dividends are falling, buyback stocks are better because they increase duration. Conversely, when interest rates are rising, dividend stocks are better because you gain from that reinvesting your coupon or your dividends at a higher rate. So when investors are pondering whether you should go with buybacks or dividends, ultimately it all boils down on your outlook on interest rates. Now, personally, my outlook on interest rate for the past year has been extremely bullish, meaning that I expect interest rate to go higher, much higher for much longer. I believe we hit a secular low in bond yields at about 1.3% in June 2016, and that it's going to keep going higher and higher and higher. Today we're at about 3.10 on the 10-year, but I expect to go to 4, 5, 6, 7, 8 eventually. So with that outlook, I actually see absolutely no reason to celebrate the amount of buybacks. I would actually see it as a risk for equity owner because it stealthily increases the duration profile.